What a great point that is. So if you were to overlay the Bitcoin price movements of the last 48 hours with the price movements of the Dow Jones or the S&P 500, what you'd find is the shape of those curves are very, very similar. The Dow dropped a lot yesterday. So did the S&P 500 over the last several days. So the difference is the amplitude. Why did those markets drop 2 or 3%, whereas crypto markets dropped 30%? And the answer to that is because there's a lot more price discovery in traditional asset classes. And that's because you have swaps and futures and shorting trades. The problem in the US is that none of the major exchanges have yet been allowed to offer some of those products that would offer more price discovery to the market, which would have the effect of damping some of the volatility. So we need to think really carefully about whether derivatives would help in this space by giving us more forecasting of where prices are going in the future. You have that for equities. You don't have that for Bitcoin at scale yet.
It's quite interesting because some people will be looking at this and saying, look, you're talking your book as an exchange. You're saying, look, we need more power, more ability to have exchanges to trade crypto products. But you're also saying you want more competition. The risk here is perhaps that regulators come in and say, we need to protect consumers. We need to crack down. And actually what you're saying is we need more liquidity, more exchanges, perhaps more degree of transparency. Don't wait on including an ETF product for crypto as well. Allow people to trade these in more ways.
Yeah, that's exactly right. And here's the dirty little secret of exchanges, which kind of flips the script, Julia, on your question. We, at an exchange, did amazingly well yesterday because when prices are moving rapidly, exchanges get a lot of buyers and sellers. So my exchange traded about $3.5 billion yesterday, which is an all-time high for us. We made a lot of money yesterday in transaction fees. But that's not ultimately good for the market because we're not here for the transaction fees. We're here to incubate the foundational technology of crypto. And so even though exchanges do very well when people are rapidly selling or buying, the adoption rate of this depends on people having more confidence in what these networks are that back the value of the tokens. That's what needs to come next.
It's quite fascinating because those that were watching will have seen Coinbase and, that's listed. It's the only one that really we can gauge because it trades out there like a stock. That was down double digits at one point. So even though, to your point, sort of making hay while the sun shines because you benefit from the volatility, the broader sector took a pounding.
Exactly, because think about what stock prices represent. Stock prices don't represent how much money Coinbase made yesterday. They're the market's expectation of future revenues. And the future value of these things is not based on one day's price movements. It's based on the long-term adoption rates of the ecosystem. So again, that's what we all have to build here.
We keep talking about crypto like it's one thing, and it isn't. And this goes back to the point you were making at the top. We have to look at Bitcoin, at Ethereum, at XRP, if we're looking at that. And I'm mentioning the big ones here. We have to look at them as different assets that they have different underlying technologies and purposes, because otherwise we can't differentiate. And in the same way that you would look at a stock, perhaps an Amazon, and say, look, these are the fundamentals of this versus GE, for example. Do we need to be doing that with crypto at this stage as well?
Yeah, so I get a lot of questions about whether the problem here is crypto infrastructure or the underlying tokens, or whether it's more about investor understanding. And as your question suggests, I think it's really about understanding. So think about it this way. Nobody wakes up in the morning and says, you know what, I need to get into stocks today. Instead, what they say is, I think Apple's got an amazing new product and I want to buy Apple stock. Or they think, I think the industrial economy is coming back and I'm going to buy US Steel or General Motors. Every one of those stocks represents the prediction about the future success of the enterprise. And in crypto, it's about what's this network going to do? So if you believe financial apps are going to go online, then you're probably going to buy ETH tokens because you think Ethereum will be the platform for those financial apps. If you believe decentralized cloud storage is the future, you're probably going to buy Filecoin because that's what's going to compete with AWS on the decentralized web, et cetera, et cetera. But we still live in a world where most people think crypto is some fungible magic internet money. We need to educate people beyond that because there is real value here, but you have to understand what it is.
It's so funny. As I was talking there, my team, some genius in the background showed the relative chart of Amazon versus GE. There were some winners and them, some less than winners, quite frankly. And I guess that's the same in the crypto space. Some of these digital currencies, some of these tokens are going to disappear. We have to accept that. Some of them are going to be wildly successful going forward. Is that the message?
It totally is the message, Julia. And we have to be comfortable with that because in America, the reason that we're a developed, rich society is because we've allowed people to take risks, to invest in companies and over time to let those companies be replaced by better companies. So most stocks that have ever traded on the New York Stock Exchange eventually went to zero because their companies got beaten by somebody else. You can think of the great stocks of yesteryear, the international harvesters, the bank stocks that went away in the 80s. But some stocks represent long-term generational value, and they're still with us. Same is going to be true with crypto tokens. There will be some networks that will be with us in 20 years, and some that you'll never hear from again. The value of the tokens is based on your prediction of which ones are going to be the winners, not dissimilar to the stock market.
And so if you're going to invest today, you just have to accept in the interim, there's going to be volatility, and it's going to be big volatility.
I think that's right. But what I also think of is I think that regulators and politicians of both political parties are going to recognize that price discovery is a good thing. We need our markets to function better. And the best assurance of investor protection, honestly, is more liquid markets. So if we can have our politicians help by allowing products that bring